Happy New Year, everyone, and welcome back to Pillow Investment Partner. My name is Sarah Savalak, and I have with me Alpha Bar, our CIO. Today, we want to bring you to the market outlook of 2023. So let's hear from Alpha. Alpha, what do you think the market would look like in the next years?
Hello, Sarah, and hi, everybody. Happy New Year for 2023. Hope for the best in 2023, and hope the year is a better one for investors.
For everyone.
Than it is in 2022. But in terms of the outlook, Sarah, I think we should cover maybe four things: inflation, the Fed reaction function, the markets, and then the risks to the markets.
Great. Yeah, I agree. So let's start with inflation.
So the message we have on inflation is a bit more optimistic this time around. I think that inflation has peaked, and I think that inflation is coming back down pretty substantially, right? Different measures we look at, you know, the annualized 3-month moving average versus the 12-month. The base effect of the first half of last year was high base effect.
Right.
So if you compare these numbers, the numbers coming up in the next 6 months versus the numbers in the first 6 months of last year, we should get lower inflation. And we're seeing that inflation is tracking at about half of the annual rate, so 3.5% versus 7%. So if inflation comes in at 3.5% in the first half, that's very good news. And I don't think that is in the markets right now. I don't think that's consensus.
So, which means that we might see that the price stabilize, not going up as much anymore.
Yeah, so there's good news for everybody, hopefully. You know, food is not going to be as expensive, and things are not going to be as expensive going forward, in the next 6 months at least.
And then, when the inflation is stabilizing, then what would happen with Fed?
Yeah, so we have to talk about a little bit about the second half of next year, which is of this year, sorry, which is a bit
Right,
more murky before we get there, Sarah. But in terms of the second half, you know, we think that inflation can continue to fall just because the economy is slowing down. But it's also a bit more risky because, you know, as China opens up, there's more demand for energy, and so we might see higher energy prices, but we might see higher energy prices driven by China, but lower energy prices driven by G7 countries. So I think on balance, energy should be probably flattish to down or up slightly, but not much much more aggressively going forward.
Right.
So I think on balance, inflation should be well behaved this year. And you're right, if inflation is well behaved, then the Fed doesn't need to tighten too much. Certainly, you know, the bond market, who's very, very strong and insightful in terms of inflation outlook, the bond market is sending us a different signal. The bond market is saying that the Fed does not need to tighten too much from here. Fed officials are saying, on the other hand, that they will tighten some more because they want to protect and maintain their credibility, which is understandable because they missed the boat last year in terms of the transitory nature of inflation. But at the same time, the Fed politically and even economically needs to be able to justify higher rates. So if inflation is coming down significantly, the Fed does not have much of a justification to keep raising rates aggressively, right? So we have to believe that, you know, we're close to the peak in terms of rate increases in terms of the Federal Reserve.
Oh, that's a good news for me as well. So, what about the market?
Yeah, well, if inflation comes down significantly and the Fed is close to peaking in terms of higher rates, then the market should be bottoming, all else equal, obviously. And you know, the other thing to look at is the markets generally don't go down 2 years in a row.
Right.
The last time this happened was in 9/11, and hopefully we don't experience 9/11 again, right? So with a big downside last year where indices were down 20%, that's a lot of bad news already in the market. And so we think that the market could be bottoming here. Obviously, valuation is still not super cheap, but we think that all is equal. We're a bit more optimistic about the markets going forward.
That's a light at the end of the tunnel.
Yeah, hopefully, yeah.
What about the risk to the market from this point?
Yeah, so I think there are three major risks. One is, if inflation proves to be again more sticky than we think, then obviously the Fed needs to be more aggressive, and with higher rates, multiples will continue to compress. The other risk that we should think about is valuation. Right now the market is trading at 17 to 18 times earnings, down from 24 times earnings or 25 times earnings 12 months ago. So as the multiples have compressed, the market's getting cheaper, but not historically cheap. It's just cheaper than last year.
Right.
It's not historically cheap. So there is potentially some scope for multiple contraction to continue in certain sectors, obviously. And then the other risk is geopolitical risk. We talked about China a little bit. There's also the risk about Russia and Ukraine and how that impact the inflation and Fed discussion.
Right. So then this year it seemed like it could be better than last year, but still there's still risk there. It's not like risk free. So what would be our investment strategy?
Our investment strategy is not predicated on this year alone. It's predicated on the long term, right? So we in the long term, we believe we should be in a concentrated portfolio of quality names with a strong secular growth tailwinds. That's what we think should work in most market environments.
Yes. So even though we do this market outlook for 2023, but that doesn't mean our core is diverse from long term to short term. So we actually look further than that. But then it's still important for us to be aware of what might happen this year, because that is going to show up in the volatility of our portfolio. Thank you so much for watching. And if you have any comment or you'd like to know more about any topic around investment and finance, please leave a comment and help us click share and like. And see you next month.
Thank you.